The boards are red again like a poppy field after a major war, and even considerably decent earnings reports are failing to make a dent. It's Thursday, January 28th, and here's the financial breakdown. U.S. stocks continue south, the Nasdaq closing 2.61% down yesterday after the Fed kept interest rates steady at yesterday's meet. According to Reuters, the U.S. economy contracted by 3.6% in 2020. That's its worst pace since World War II. And Bloomberg this morning ascribes a large part of the shares' turmoil to the volatility driven by the influx of retail traders into the market. The result, they say, is the departure of many institutionals from what is becoming less and less of a reliable investment. On the economic front, mortgage applications increased marginally this past week, and durable goods orders fell less than expected month-on-month in December. This afternoon, the U.S.'s quarterly GDP reading, retail data, and new home sales, all which could increase the current dollar surge as all those share sellers look for where to park their money. The economy continues drawing indexes down in Europe, sharply uncharacteristically for earnings season, even during a pandemic. Most data was relatively calm, barring German consumer climate, which doubled its depth into negative territory, minus 1561 for February, and German consumer confidence for January now down to 92 points. Reuters reports that the German government has slashed its GDP expectations for the year, while the ECB is said to be considering an interest rate cut. We should keep an eye on EU data this morning, various sentiment markers at 10 GMT, and a speech by the central bank's Isabel Schnabel. Meanwhile, Reuters is reporting post-Brexit clouds on the UK economic horizon. Apparently, raw material deliveries are already taking a hit, which could hurt economic output by about 1%. Equities contagion easily spread into the Asian session, drawing the export-driven Shenzhen composite drastically down by 3.25%. 1.53% represents the worst Japanese performance in 6 months, despite excellent results for Mitsubishi, Isuzu, and other Japanese giants. All this thanks to disappointment in U.S. tech company earnings. Bitcoin has been forming a wedge over the past 2 weeks amidst warnings against U.S. inaction vis-a-vis China's digital yuan. CoinDesk today published a report from the New American Security Center that details the authoritarian dangers of China's exporting its digital standards abroad. This, they said, could result in real-time monitoring of all private financial dealings. Now, today's fiat currency system relies on the presence of central banks and private financial institutions as a kind of firewall between governments and private enterprise. A digital yuan controlled by the Chinese government would destroy all that. Meanwhile, Tuesday's API withdrawal and the EIA's report last night of an 8 million barrel drawdown did very little to prod prices. As we can see, we've given up on breaking above the 53.20 line for now, and there seems to be a new resistance developing at 52.60. Western Energy Alliance, a group representing 200 oil and gas companies, is challenging President Biden's moratorium on oil gas drilling on federal land. After rejoining the Paris Climate Accord on his first day in office, Biden charged his climate advisor to begin planning the largest carbon cut in history, in U.S. history. Major investors are worried that the U.S.'s oil supply might be endangered, but the new president is apparently more concerned with what he's calling an existential threat. In corporates, Toyota regained its lead over Volkswagen as the world's best seller. It reported yesterday an 11.3% drop in sales year-on-year compared to the German maker's 15.2%. Analysts expect that the result is thanks to Asian markets being less badly hit by COVID lockdowns than their European counterparts. And with competition heating up, Tesla edged by revenue expectations by $1/3 billion US. Facebook shareholders were treated to a 52% increase year-on-year in earnings. Levi Strauss lost 12% year-on-year in revenues. AT&T lost 2.3%. And Apple sales jumped 22% in Q4, beating back Huawei as US sanctions against the Chinese phone company take effect. Again, Reuters is reporting that the Biden administration has vowed to maintain its Trump-instigated pressure against Chinese telecom, but it's delaying Trump's ban on Chinese companies related to the military from today till May 27th. Today's earnings calendar includes Visa, MasterCard, Comcast, McDonald's, Southwest Airlines, and in the UK, EasyJet. Finally, Australia has ratcheted up the war against Google by a notch. The national regulator is set to limit the company's access to user online data after Google threatened to disable its search engine in Australia if the ACCC forces it to pay for local news content. Well, I'm afraid that's all we have time for this morning. We'll see you tomorrow as the week draws to a close. Bye till then.